Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Steve Roll, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel, will be joining us for the hour. Then in 30 minutes, we'll be joined by Maria Solovyeva, economist at TD Economics, to answer the question of, is Canada actually attracting productive foreign investment and how much of it is coming in versus going out? We also want to hear from you this morning on First Call. Reach out with your questions on stocks, and we'll have Steve answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you want to call and you're a little shy, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg Newsroom. Canadian grocery company Empire posted a loss of more than $380 million in its latest quarter. The loss was driven by a one-time expense tied to shutting down its Voilà delivery facilities in Alberta and pausing online expansion in Vancouver. Despite the write-down, the company still managed to slightly beat third-quarter sales estimates. Aluminum prices have hit their highest level since 2022 as the war in the Middle East continues. Prices have climbed above $3,500 per ton, driven by supply chain disruptions in Iran, which accounts for about 9% of global output. The ongoing conflict has tightened supply and fueled the rally. Shares of Dollar General are down in the pre-market about 5.5% right now. This after the company posted a sales outlook that came in line with expectations. Some analysts believe the forecast signals slowing momentum after consistently beating expectations. Despite that outlook, the discount retailer beat fourth quarter estimates on both revenue and sales. The stock saw a surge of 75% in 2025 as the company benefited from consumers seeking deals and lower prices. And now our top line story. Oil has spiked again near $100. Iran stepping up attacks on shipping in parts of Dubai. The latest attacks reigniting concerns about the war's impact on global energy flows and the Strait of Hormuz. For more on this, let's bring in our guest for the hour, Steve Roll, Senior Portfolio Manager at Trivest Wealth Counsel, Wellington Altus Private Counsel. And Steve, thanks as always for joining us. Another interesting day. We had the release of the oil yesterday, but we're still seeing oil pushing $100 again. Where do you think this is going? Did we not do enough, or did the IEA not do enough, you think?
I think the IEA is doing all they can. It's very difficult for them. They've stepped up, but it's not enough. This is more of a military development than anybody expected. The question is how long is this going to go on for? But when ships are being attacked on a regular basis here, this is extremely important. I think the biggest news is that the U.S. is not able to escort some of these ships. Going back to 1987, when Ronald Reagan escorted Kuwaiti ships during the Iran and Iraq war, that sort of set precedent about what can be done. But if the U.S. can escort these ships at this time, that's going to create more and more tension and more supply disruption concerns here.
And the interesting thing is Iranian oil tankers are getting through.
Yes, they're getting through, and some Chinese destination ships are getting through as well. I expect that to continue, but it doesn't really. It's not enough to really calm down the storm about what's actually happening with the supply disruption. So that's why we're seeing the volatility. Yesterday was an incredible day for the oil markets, one of the most incredible in my 30-year career, seeing that it was touching 100, and now it gets back down to mid-80s, and now last night was at 100, now we're back at 90. So where's this going to go? Nobody really knows until we know when this war is going to end.
Well, and I think that's what the oil tankers, the Iranian ones getting through, that's still providing them funding. And so the Americans, can't even economically handicap them. So they keep getting money coming in, which is what they desperately need. I think it's like close to 25% of the government's income sources from oil So this this kind of funds the war for them.
Yeah, definitely. I mean, it's funding the war for not just Iran, and China keeps getting their oil, and Russia's going to benefit out of this as well. So it's a situation that military direction needs to be taken by the U.S. about this. So things continue to escalate, and anybody who has the notion that this is going to be a short-term Venezuela type of conflict is proven wrong right now, because we're at day 13 and we expect more of this to continue.
Now, one of the, relatively good signs, I guess it hasn't spread. It's been fairly contained. I know Israel has gone after Hezbollah in Lebanon, but for the most part, this has stayed somewhat contained. What would happen if this started to expand? Like if we saw Saudi Arabia get involved, or do you think they would even get involved?
Yeah, I think that's the next move. I think the Saudis are the critical factor on this. I think there's some reports that there's concerns that Iran may start attacking ships on the Red Sea. So that's the Suez Canal. That goes back to 1956. That's what we cannot have here. But I think that there is a bit of an alliance between the U.S. and Saudi Arabia, and I think there's some conspiracy theories, whether the theories or not, that MBS was part of this decision to attack Iran. So I think that it's critical what happens with Saudi's next move here.
And of course, this is having a huge impact on the markets, but that also means some opportunities, doesn't it? Where are you kind of keeping an eye right now? We're going to talk a little more about some companies, but what are some possibilities, like directions you can head with this?
Yeah, good question. There's always opportunity when there is conflict, but it's, today it's like day by day where to go. And I think the most important thing is to stick with your plan and not react too directly. But there are some benefits. Obviously, the oil sector is doing very well. Canadians oil is doing well. Exxon, Chevron, the big integrated oil companies continue to do well. I think another space, unfortunately, is doing well as well is the defense sector. And that's something that we have invested in with RTX and British Aerospace, done very well through this, but I say unfortunate just because it is profiting off war. But something else that's actually doing quite well, we're seeing it in Mosaic and we're seeing it in Nutrien, is potash. And the potash stocks are doing quite well, obviously, because Turkey's launched a ban of exports for fertilizer. So fertilizer stocks continue to do well. So we're seeing the second wave of impact as this war continues.
Okay, and we're going to talk a little bit more about the impact on Canadian energy names when we come up after the break with Steve. That's just ahead. See how things are shaping up on the markets. We'll start with U.S. futures. And you can see the day of red there is shaping up right now. Dow off by 0.85%. All this, of course, on oil. NASDAQ 100 down by 0.63. And the S&P 500 0.66. As traders brace for another volatile day. Heading over to Asia now. Investors de-risking on tech, exporters, and travel. And you can see the Nikkei down by 0.0 point, Hang Seng off by 0.7, and the CSI 300 off by 0.36. We'll go to Europe now, and same situation. It's a little better. It's a questionable word for that, I guess. Airline, consumer, and rate-sensitive stocks are weighing things down. You can see the FTSE off by 0.25 point. CAC 40 off by 0.3. DAX right now is a wash. So what did the TSX do yesterday? it was off. They had rising energy names, but it couldn't offset fears of global inflation. That weighed on the rate-sensitive sectors. It was off by 0.45%. Some of the movers: Secure Waste Infrastructure up by 6.9. Parex Resources 6.34. Going the other way, Constellation Software down by more than 8%. And Go Easy continues to get hammered on that earnings report, down another 18%. Taking a look at metals. It's one of the calmer spots, I guess you could look at there. Gold off ever so slightly, pretty much a wash right now, just below 5,200. Silver right around the $87 mark, up 1.86%. And copper down slightly at 0.09%. Western Canadian Select yesterday surged again, up 5.4%. The differential widening slightly, though. And, of course, WTI today, more pressure on it. Those hits on the ships in the Strait of Hormuz scaring investors, even with that release of oil by the IEA. So you can see WTI up 6.8%. All right, continuing our conversation on crude, we're back with Steve Rolls of Trivest Wealth Counsel, Wellington Altus Private Counsel, to break down some of the biggest winners in Canadian oil names. And the one that comes up off the top that you like, CNQ. Yeah,
CNQ is one of my core holdings for a number of years. I think it's one of the best well-run companies in the country. Top-tier asset, top prudent management. Their dividends, the highest dividend. I think it's great value as well. So I think it's just one of those stocks that is in the right place at the right time right now. And by the chart, we can see there that the incredible growth that it's had year to date here.
Have you ever had a time when you thought about selling it? Was there ever a point? I mean, you said you've had it for a while. Was there anything at one point that said, well, maybe it's time to get rid of this?
I think last year when things were a little depressed there, and in Canada we always have these situations of great company, great resource, great sector, but unfortunately we don't have great politics here to get a pipeline through. But with these, so there have been times, but it's just one of those core holdings where you're getting over 4%, so you can always wait if things are a little bit depressed, and you're getting 4% to wait for the sector to return. It always pays off. I mean, the one thing I really like about CNQ is that they're a real dividend compounder. Their compound annual rate of return on their dividend is over 20%. So it's been paying dividends for 25 years. It keeps growing. So it's just one of these incredible companies that we have, a cash flow machine.
Any concerns that it's at the point where it's almost too perfect?
Great question. I don't think so. I think that there's still value there. Their PE is about 20, and compared to like Cenovus, which is 33. So I think it's still Canada's darling when it comes to this sector.
All right, and Cenovus, let's talk a little bit about that. And what any concerns, likes, dislikes to it?
I like it. I think it's in a good space. It's profitable, and it is doing quite well. But I just think from relative to CNQ, I just prefer CNQ strictly because of the valuation. Cenovus has had a good run over the past 2 years, and it's now time for CNQ to step up a little bit. So I think that just from a valuation play only, I think they're both great companies.
And one more, I just want to sneak in, then I just want to ask a broader question. Suncor, thoughts on that right now?
Suncor, you really got to look at Suncor as being the integrated. So when we go to Petrochem, that's Suncor. So I think it offers kind of a balance between. So my two core holdings for oil in Canada are Suncor and CNQ. When you're doing the refinery and integrated retail, it just provides a little bit more diversification. So you get a little bit more torque from CNQ, but you get a little bit more stability from Suncor. So at the end of the day, it's a great sector and a great country, and we're in the right place with oil right now. Let's just find a way to get it out.
And I mean, that could be the big thing that derails it, because it does feel like this is a moment where Canada could shine and take advantage of the situation. Are there some hidden gems or hidden opportunities that you see coming out of all this in the Canadian oil industry, or anything connected to the Canadian oil industry?
I think LNG is something that's on the table right now. But as I just said, we have to get it out. I think that if we're moving LNG from Canada down south, well, that's going to be a big discount. So if we see natural gas prices continue to expand here, Canada's not really going to be a part of that, because if we ship it down south, it's going to cost a lot of money, and so our prices are discounted. So I think we're just at a state of stability when it comes to oil. We're not in a growth area for our oil exploration, and CNQ discussed that last week, but when they announced that they wouldn't be expanding as rapidly.
All right, Steve, we're going to take another break, but I know you're sticking around. We're talking private credit markets when we come back. They're starting to show some cracks, and we'll break down what's behind it and why Canadian investors should pay attention. Private credit is drawing fresh attention as the global market faces rising defaults and liquidity pressures, while Canada's smaller market remains more stable but still exposed. Let's break down what's driving the stress with Steve Rolls of Trivest Wealth Counsel, Wellington Altus Private Counsel. Steve, the Ontario Pension Plan just announced their earnings for last year, and they took a big hit when it came to private equity this week, didn't they?
It did indeed. Yeah, we saw that. We're seeing that every day. We're seeing some news earlier today. Saw that Deutsche Bank announced that they had exposure of about $30 billion to private credit. It's very reminiscent of the summer of 2007. Reminds me of the days when Bear Stearns was announcing that they had a few hedge funds in the real estate side of things that started to implode. And what we're really seeing is a lot of the private credit funds are now starting to gate the redemption. So if you want your money out, you can't get it out. And it's causing some concerns and questions about contagion.
And just how big is this market?
The market right now in the U.S. is about $2 trillion, and it's expected to grow to about $4 trillion. And the thing about private credit is that it's really an extension of what happened in 2008 when the financial crisis and the bank regulations that came in. At the end of the day, people still want to borrow money, and there are people out there who will still lend money. And the banking industry took a step back, and the private industry stepped in. And the ones who are really, a lot of these credit funds, the demand is really coming from the software companies who are obviously going through a challenging time with AI and whatnot. So the space is growing in the U.S. It's been a real demand situation, but in Canada, it's still relatively a pretty small market, so we are somewhat insulated.
Now, is there a concern of this kind of getting into a too big to fail, or could we see hits, but something that they can come through?
We're seeing defaults right now about 3. The average default for private credit is about 3%. It's starting to jump up, but the issue is that we don't know, because it's such an opaque sector. By opaque, I mean it's not transparent. We don't really know exactly the extent of it because it's private, it's not public. This is part of the issue I have with some of the private credit funds out there, that they are so opaque. You don't really know what you're buying. They're promoting strong returns, but you don't really know what's under the hood there. If I buy a stock like Microsoft or Apple, it's trading 220 days a year. I can sell it. I know what's happening. I can see the reflection. But with private credit, if it's only being valued at most 4 times a year, sometimes monthly, but it's not really valued that much. So you don't really know exactly the contagion impact here. So it is quite concerning to what's happening in the States.
So how do you even do your homework on this then?
Great question. For myself, I stayed away from the space. It's just a space that I've never really been attracted to. I used to work in Asia for over 10 years, and I saw the credit markets fall in 2008, and actually saw bank runs at that time. So I've always been anxious about the space. When I came to Canada, returned to Canada about 2017, there was a lot of discussion and the growth about alternative investments, and private credit was coming back. And I just, every time I would look into the space, I just didn't really feel comfortable with it. I think there are some good private credit companies out there, but they're also being lumped into one. So it's a space that I tend to avoid.
And you mentioned that the Canadian private credit market is not as big. It's a little more stable, but is it still susceptible to big banks involved? What concerns are there for that?
In the U.S., the exposure is estimated to be about $300 billion. So it is something that can be facilitated if there is an issue. I don't think the Fed will have to step in. In Canada, we don't have a big private credit market because the banks still lend out about 90%. So it's not a big market, but you're seeing stocks like GoEasy is kind of a situation where when you do go into this secondary shadow banking type of investing, it doesn't always work out. And we're seeing that in Canada by GoEasy. But just like in '08, the big banks in Canada continue to outperform relative to the rest of the global banks. Why? Because we're a little bit more prudent on our lending here. So I'm quite confident in the Canadian banks here.
Sometimes playing it safe is the best way to go.
It's the Canadian motto, and it does tend to work out, especially in a space that's so opaque. You can't sell it, you can't touch it, you don't know what's happening, and it's just a space that I'd recommend you really, really, really do your homework.
Okay, we'll wrap it up there for now, but still lots ahead. We're going to be talking about foreign direct investment in Canada reached its highest level since 2007. We'll find out why with our next guest. And our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. The Canadian government is asking oil companies to release some of their reserves to support the International Energy Agency's plan to inject 400 million barrels of oil into the market amid the conflict in the Middle East. The Canadian government is also in talks with oil sands producers to explore near-term opportunities to boost output. Canadian grocery company Empire posted a loss of more than $380 million in its latest quarter. The loss was driven by a one-time expense tied to shutting down its Voilà delivery facilities in Alberta and pausing online expansion in Vancouver. Despite the write-down, the company still managed to slightly beat third-quarter sales estimates. Shares of Algoma Steel are down in the pre-market after the company missed revenue estimates and reported wider losses in the fourth quarter. The Canadian steelmaker says tariffs weighed heavily on results, noting it paid more than $60 million in direct tariff costs during the quarter. Tariffs have been pressuring the company since they were first announced, with Algoma saying in December that it would eliminate roughly 1,000 jobs. And U.S. futures right now, quick peek at them in the red. Oil putting that pressure on, of course, with the latest unfolding in the Strait of Hormuz. Reports of ships being fired on there and oil not getting through. So that's putting pressure on as oil pushes up towards $100 a barrel again. Well, foreign direct investment in Canada reached its highest level in 2025. Numbers last seen in 2007, nearly 2 decades ago. Here to talk about where those investments are coming from and what's driving them is Maria Salaviova, an economist at TD Economics. Maria, thanks very much for joining us.
Thank you for having me.
What has driven it to this point? Is it energy that is that where we're seeing the money going to match numbers we haven't seen in 2 decades?
So it is. We can see from the sectoral basis, there are a few sectors that are dominating that. One of them is trade and transportation, and we also see some things from the management companies. So these are your financial companies like pension funds, banks, and things like that. We also see a bit of a slowdown in some of the mining FDI relative to previous years. So it's a combination of things, and we'll know a little bit more later on when Statistic Canada releases information on by country and sectors as well.
Okay, and Steve, I know you want to join the conversation.
Oh, yeah. I just looking at fourth quarter and how much of the FDI increase is really related to the mergers and acquisitions, specifically Anglo Tech. That was close to $60 billion. And a couple mining companies, and Onyx bought an insurance company about 10 billion. So there's a lot of like foreign investment coming in, but mergers and acquisitions. So it kind of reminds me of the late 90s when our mining companies were being purchased by a lot of foreign companies. And is this really, is a strong FDI number something to celebrate or something to be concerned about in Canada?
Yeah, just by the flow of the volumes, like just the mere volumes flow of FDI, is very difficult to say. You're right to say that this was primarily driven by mergers and acquisitions, so foreign direct investment going into Canada. And it's hard to tell on the aggregate basis. So we really have to dive in and look at the types of companies. And if we see things like mining, things like manufacturing, FDI going into these types of companies, it helps expand capacity in the long term. So those types of investments eventually will have, like any investment, we need to understand what it is that this flow represents. Like any investment, when you put funds into the company, you expect returns. So at some point, those companies that are investing in Canadian companies will see the returns in terms of dividends, in some earnings, some sort of earnings. So that could potentially flow out of the country. But if it creates the capacity for exports and creates that partnership, it actually could be good for the country as a whole. And we are in a position right now where we do really need to expand that capacity. And seeing things like FDI going into transportation, for example, as a large sector. Again, we don't have the explicit details of what exact companies these FDIs are going into. But if you create that flow, it helps us to expand the infrastructure capacity as well. So remember, we do need to get to that point where our port capacity is expanded.
And I just want to ask about, the mergers, M&As from the UK, a lot of that was the mining. Were there other areas where money came in from the UK?
Well, from the UK, we actually, so the information that we are seeing, we kind of tried to put a mosaic together from the Statistics Canada data, as well as some of the information that we're seeing from other sources that is a little bit disaggregated. And then what we see from the UK, so there is, we assume that one of the larger flows in terms of volumes was coming in terms of the expanding capacity and purchases in the transportation, maybe mining, but majority in terms of the number of transactions, we see most of the filings, UK filings, were coming from purchases of software companies. So they can be smaller in volume terms, but the interest from the UK is coming in terms of numbers coming for software.
Steve, you got a question?
Just, do you have any insight into, Roger mentioned it from the beginning, insight into the energy space with Prime Minister Carney signing MOUs with Premier Daniel Smith back on November 27th. The Canadian companies aren't keen on investing in Canada for regulatory reasons and environmental reasons. Bill C-69 is obviously the one that we're all talking about, which needs to be reformed in either to attract investment. But the Canadian firms aren't going to invest in Canada. Are we seeing foreigners wanting to come and invest in our infrastructure and our energy so that we can have more productivity in this country?
If we look at the FDI flows specifically, there was, definitely a growth this year. And so I think that foreign companies are looking at Canada as a good prospect and good investment. I would just say that for Canadian companies in general, this year was a bit of a pause. They hit a bit of a pause button on any type of investment. And we've seen it also in the flows out of Canada going into other countries. We noticed a very sizable slowdown in investment into the US. Whereas other countries, there was a bit of a slowdown, but I wouldn't really say that it was that particular. So there is a definitely, because of the trade uncertainty, Canadian companies are a little bit on the sidelines right now, waiting to have that fog of trade uncertainty clear before they start investing. And the biggest indicator of that in terms of international transactions is definitely FDI, so Canadian investment in the US, driven by decline in mergers and acquisitions.
Okay, Maria, we have to wrap it up there, but thank you very much for joining us.
Thank you very much for having me.
Maria Saliviova is an economist at TD Economics. Still ahead, we'll continue our coverage of oil markets and what the latest attacks means for global flows right after this. And our phone lines are open. Steve Rawls taking your questions on stocks. Call us at 1-855-326-6266. You can also email firstcall@bellmedia.ca. Oil supply risks are rising again after Oman evacuated a key export terminal and 2 tankers were hit in Iraqi waters. With tensions escalating, Bloomberg's Will Kennedy tells us what this means for global energy flows.
2 oil tankers off Iraq were hit, and Oman has ordered its port outside the Strait of Hormuz to be cleared. What does this mean then for supplies coming out of the Gulf?
It shows that Iran is making a concerted effort to impact the export of oil out of the whole region. It seems to have stepped up attacks on ships inside the Persian Gulf. These ships in Iraq are at the north of the Persian Gulf, so a long way from the Strait of Hormuz. So the effort is against shipping through that whole area. And then separately, we've had this incident in Oman. Oman is not one of the biggest oil suppliers in the region, but a significant oil supplier. But importantly, it lies outside the Persian Gulf. So here you have Iran trying to impact supplies even outside the Strait of Hormuz. The big picture here is all of this means that the Strait of Hormuz is firmly closed, and that will be of huge concern to energy traders globally. Some of that impact has been offset in 2 ways. The announcement of this big stockpile release that we had yesterday from the IEA, and we got more details about what the US is going to do there overnight. And it's also being offset by the ability of Saudi Arabia to export from the Red Sea. But the longer that goes on, these will not be enough, and concern will re-emerge about how much oil production and exports we're losing, and we may see prices ratchet higher again.
On the action by the IEA, as you say, it seems to have been reversed, at least the price move, based on what's been happening since then in terms of the attacks in the region. Does this mean that the IEA will have to go, or rather the countries holding strategic reserves will have to release more? Can they do more? I
don't think we're there yet. There will, of course, be a concern that stockpiles, emergency stockpiles, are finite, and you don't know how long this crisis is going to go on. You don't know what else is coming at you. So there may be a reluctance to do too much too quickly because you don't want to use up all the stockpiles. So I don't think we're there at the moment. The priority will very much be on trying to find a way to get the Strait of Hormuz over, and the oil market may bring some fresh thinking in the Trump administration about when and how that's going to happen. One other notable thing that we saw today, Stephen, is that China further restricted the exports of fuel from its refineries, jet fuel, diesel, gasoline, etc. And that shows that the impact on a country like China is real, even though China has some of the largest strategic oil reserves in the world.
Yeah, and has been building those up for many months, as we have reported. I think there's also another word to mention, though, hoarding. I noticed that Carlyle's Jeff Curry talked about that as he discussed this with Bloomberg only yesterday. Keep hoarding down. That perhaps is the worry, as we're also seeing many people try to game out scenarios for where the oil price might peak now.
This is always a problem at these times. The natural thing to do if you read the news, whether you're a company, whether you're a driver, whether you're a homeowner who heats your house with heating fuel, is to think, well, I should get ahead of this, I should fill up my tanks. And that's rational on an individual basis. But of course, if everyone tries to do that at the same time, you create a rush, straining what are very complex and precise supply chains and sucking out inventories, and that can cause its own problems, even though supply is ample. So that will be something to watch, and that's something a concern. Just anecdotally, you hear here in the UK that people are filling their heating tanks, even though it's the end of winter, before prices go up, and it's very hard to find that heating oil, and prices have more than doubled in some places. So it can be a really real thing, both at the micro level and at the slightly more macro level.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a buzz for Bumble. Let's take a look at some of the notable calls and recommendations. Analysts apparently falling in love with Bumble. JP Morgan has upgraded the online dating stock from underweight to neutral, citing stabilizing user trends, better than expected Q4 2025 results, and an upcoming AI-driven product revamp, Bumble 2.0, which is expected in the second half of 26. Following the news, Bumble shares surged due to improved investor optimism in a completed member quality reset. Well, there have been investigations on whether fraudsters are staging car collisions and driving up premiums across Canada. W5's John Woodward of CTV News has more in this report.
This is dashcam video of a car cruising along Toronto's Highway 407, and it abruptly turns and hits a guardrail. No one was injured. The driver claimed he swerved to avoid another car and looked to Aviva Insurance Company for a potential payout of thousands of dollars. And that's where investigator Mike Cardillo comes in.
You'll see this car right here going very slowly onto the on-ramp.
Cardillo's team checked out the highway's traffic camera system to see the crash from a different angle. Same guardrail crash, but there's clearly no car the driver is trying to avoid. But that video reveals something else unexpected.
If you can see this car right here, he was following closely.
There is another car, but it's farther back, and as the traffic camera records, you can see the pair switch before anyone else gets there.
You get footage like that, it tells the whole story on what exactly happened.
The person making the claim wasn't even driving the car, making any claim he was injured in that crash impossible.
Talk to me about those videos. What jumps out at you as an investigator?
That's the smoking gun. In an investigation, you have the video clear as day that the individual got out of the driver's side of the vehicle, hopped into another vehicle to take off.
A staged collision to profit off a fake insurance claim, and it's hardly the only one. Take this video of a parking lot east of Toronto. A dramatic rear-end crash that sparked a claim that Aviva believed was also fake, asking the driver enough questions that they abandoned the claim. Cardillo and his team have been inundated with staged collisions this year. Their figures show across the country the number has risen some 400% in 2025 to about 1,066.
We're really facing challenges with
Jamie Lee is Aviva's head of fraud and financial crime.
That's a tremendous increase.
Yeah.
What accounts for that?
What we're seeing is actually vehicle theft has been decreasing, which is great because some of the actions that government and the industry and law enforcement have been taking is working.
That's the good news. A report by a national insurance group says while some 60,000 vehicles were stolen in 2024, that dropped by 18% in 2025. But here's the bad news.
Unfortunately, organized criminals need other means to make money, and now they're turning to other auto fraud-related crime.
Auto thieves are moving over to insurance fraud. Aviva, not the only company to be hit. An investigation last summer in Peel, west of Toronto, revealed a massive, allegedly criminal scheme, including violence and extortion. but a big part of it was defrauding insurance companies, including Saskatchewan Government Insurance, Cooperators, Bel Air Direct, Wawanesa, and Intact.
Today is another example of what diversification for criminal groups looks like, because they find different ways to seek vulnerabilities, exploit them, turn them into profits.
The charges not proven in court.
What does it tell you that the people who are accused of being involved in extortion and tow truck violence are also allegedly trying to pull scams?
It tells you that the money is there to be made, and more of the challenges that we're facing is that they're getting very sophisticated.
The investigators are vigilant, but can't be sure how many scams they're not catching, because these investigations are difficult without video like this.
CTV's John Woodward. When we come back, Steve Rolls takes your questions on First Call. Time for First Call and first email, and that comes from Dave, and he's asking, is now the time to buy GSY? Go easy, or is it going to zero? They halted trading yesterday. It was so bad at one point. Steve, what do you think? Are they done beating it up yet?
Yeah, go easy on go easy. I think it's a stock that I don't cover. It's a little bit small cap minded for myself, but it's a stock that I don't cover. But it's the reason I don't cover it is because I don't really believe in the space. I think down in Canada, our big banks are fully capable of providing the lending that we need. If you need to go outside of a bank, then you're taking a lot of risk, and I think we're seeing that go easy. So I would not be buying it right now. I think we look at these, when you see these type of news, you think, okay, now is a buying opportunity if it's so depressed. But at the end of the day, it's the profits are really declining. I think in September net income was about 33 million. Previous to that, it was in the 80s. So I would refrain from buying a company in this with all this news right now.
All right, we'll leave it at that. Let's get on to another email. This one from Sunny. What does Steve think about Constellation Software right now? What are his thoughts about the enterprise software stocks in general for the rest of 2026? Yeah, the apocalypse is coming.
Yeah, something that it's already come, and there has been a bounce back. We saw that with Constellation that it did bounce back a little bit. Yeah, I can see it in the chart there. It has bounced back, but now it's come off a little bit. I'm still a little bit concerned about Constellation. Their business model is it's a roll-up business model that they're out there acquiring as much software as possible throughout the years, and I think that's kind of a difficult business model right now. So I'm not a big fan of Constellation. For myself, when I'm buying any tech stocks, I tend to buy them in the U.S. I refrain from buying Canadian stocks. I like my Canadian dividends, and Constellation is a company that doesn't pay a high dividend, even though they increased it the other day. I would refrain. I think that their business model is under challenge right now.
All right. I want to get a couple more emails in. And this one from Andy. It says, good morning. Your opinion on MDA following their announcement on the U.S. IPO and listing that apparently everybody wants to get in on, it seems like.
Yeah, I find that quite interesting. I think it's a good move to get in the U.S. I think especially in the space. When you're in the space of space, it offers a good opportunity. I think the U.S. on the defense programs, I think that it makes a lot of sense. They're not a startup, and that's what needs to be really looked at when you look at MDA. They've been around for a long time. If you go back to early days in the space shuttle, they're the company that produced the Canadian arm, and that technology is continuing to expand. So I think it's a really good move by them to get multiple listings in the U.S. So good for them.
All right, sneaking in some more emails here before we run out of time. Dan, this one, would you buy KKR at these prices?
I like the prices, but I don't like the space, specifically with all the private credit news coming out on a daily basis. I refrain until we have some more clarity. I'm somebody that tends to, with private wealth, I'm quite conservative, so I tend to be buy buy the news a day late to confirm that everything is okay before you're buying something. Their peers are going through the same thing, like Apollo, Blackstone, BlackRock. So until the private credit situation is transparent and we know exactly where we're going, I would hold off on KKR.
All right, we've got about 30 seconds for this last email from Mike. Hi, I would like your guest view on Netflix. Thanks.
Netflix dodged a bullet. We were about to call them Detflix. I think that by not getting involved in avoiding the bidding war with Paramount, I think they dodged a bullet. I think they were going to take on too much debt, continue to expand our revenue growth probably in the mid-teens. So I think with their debt levels not to increase, I think that we saw the bounce. But still, it's a difficult space. It's a competitive space. We all have too much streaming. We're all paying for it. And content is difficult. So I would make it a hold right now. I wouldn't buy it, wouldn't sell it. I would just hold on for a while.
All right, we got to wrap it up there, Steve. But thanks as always for joining us. Appreciate it.
Great. Thank you, Roger.
All right, that was Steve Rolls, the Senior Portfolio Manager at Trivest Wealth Counsel at Wellington Altus Private Counsel. That's it for us for the Street. And he's up next with the Open. Trading gets underway in about 30 minutes. Have yourself a great day.